Hey guys, in this video we will talk about the collapse in oil prices and which are the stocks that you should be buying on the back of oil price weakness. Definitely not the traditional winners in a low oil price environment such as the airlines. In fact, these stocks are in a historically unloved industry, so do stay tuned for it. So the top stories this past couple of days is how oil prices have dropped below zero. Not just marginally below zero, but to almost negative $40 a barrel. I mean, what a crazy world, right? These men producers are actually paying buyers to take oil off their hands. So what exactly happened? The drop of negative $40 number of days ago pertains to the May oil futures, which was about to expire yesterday. Why did this particular month contract drop so much? Typically, when it comes to the end of the futures trading cycle, paper future position starts to roll over. Paper traders who do not want to take delivery of actual physical oil will sell their contract to someone who does want to take delivery. This is normally a pretty undramatic affair. The problem now is that no one wants to take delivery because there's no available oil storage facility left to store physical oil due to the current oil glut environment. The paper traders find themselves unable to resell it in a normal scenario, and that drove prices to a negative level as they seek to offload it by all means necessary. However, that does not mean that WTI oil prices are going to remain negative. The June contract on that day settled at approximately $21 per barrel. That is still a pretty large spread of close to $50 from the lowest point of the May contract. We will talk about this spread later, a scenario termed as oil contango. With oil prices at such a low level, which are your typical stocks which will benefit from a low oil price environment? In a normal environment, airlines will be a huge beneficiary of low oil prices. But again, we are not in a normal environment today. Demand for air travel has essentially disappeared due to the current coronavirus-driven pandemic that has crippled both domestic and international air travel globally. With absolutely zero demand, there is no use for low oil prices. Airlines that hedge for their oil commitment will realize that they are likely to see a huge amount of hedging losses, a double whammy to airlines. Consumer discretionary stocks like Starbucks, Royal Caribbean Cruises, etc. typically benefit indirectly from lower oil prices as consumers look for places to spend the money that they save on fuel. Again, not relevant in today's context where nationwide lockdowns force such discretionary services to shut down. Let's not even talk about the problems of cruise companies. No way are they benefiting from the current oil price collapse. You should know why, right? Cheap oil prices might entice people to spend on new automobiles, especially the bigger ones and more expensive vehicles over the smaller, fuel-efficient counterparts. But who is going to spend on new automobiles when the unemployment rate is at sky-high levels? Most will look to save up or conserve for a rainy day, with the intent to push their existing automobile and additional mile as much as possible. One sector that might benefit is the consumer staples as consumers spend their fuel savings on food and drinks. More so in the current context where stay-home mandates have forced people to stockpile necessities. However, not all stocks in this category will fare well. Stocks like Costco and Walmart will likely see demand holding up or even accelerate. However, stocks like Coke, for example, might see a substantial reduction in demand due to the cancellation of major sporting events, etc. Overall, the potential benefit is indirect at best, and there is no certainty that fuel savings will translate to higher consumer spendings on staples. Savings could well head into the piggy banks. Lastly, we have the transportation industry. Stocks like FedEx and UPS, which are typically key beneficiaries of low oil prices, given that fuel costs are a significant component of their operating expenses. Again, as we head into a recession or potentially already in one, the propensity for consumers to purchase will decline substantially, and that is going to hurt these transport players who are in the business of delivering products. No products to deliver equals to no business, and no matter how low oil prices might be to help mitigate their operational expenses, that is just not going to help. There is, however, one particular segment of the transportation industry that is currently a huge beneficiary of the recent collapse in oil prices and its subsequent oil contango effect. That is the shipping industry, or oil tanker segment to be exact, the key topic of our video today. Let me put it across simply. Spot oil prices have collapsed due to the glut in oil supply, which is overwhelming oil demand, which has essentially created due to half the world population cooping up at home. No one is driving, non-essential factories are not burning fuel. Yes, OPEC Plus has agreed to cut oil supply by 10 million barrels per day, but that is not sufficient in an environment where we are witnessing a potential 35 million barrels a day destruction in oil demand. That is where we get our current oil glut, which has pushed spot prices down to record low levels. However, future prices are indicating a much higher price at the moment, a concept termed as contango. So if future prices are much higher, what should you do? Buy at spot and lock in the future selling price, and immediately you will gain an arbitrage profit. Sounds like the ideal scenario. The only variability is the cost of storage during the period when one takes delivery of oil and subsequently sells it. Every trader knows there is money to be made from the contango phenomenon. The missing equation is how much to store the oil before one can sell it. If storage cost is high, then there might not be any profit to speak of, potentially even losses. And storage costs have indeed increased substantially as spare capacity dwindles by the day as oil continues to flow out from the ground much faster than they are being consumed in today's context. That is why oil companies have turned to oil tankers to store their oil, and as the supply of oil tankers dwindle, the cost of renting these ships is now through the roof. Typically, oil tankers benefit when economies are growing and demand for oil between nations is high. That will lead to greater demand for cross-nations oil transportation. Particularly in China, which consumes more oil than they produce, economic growth in China will lead to greater demand for oil imports, and consequently demand for these oil tankers to transport oil from export nations such as the US to China. However, they are also a huge beneficiary now that global growth has come to a standstill. While the primary reason for using oil tankers has disappeared, the secondary reason, which is a form of oil storage, has taken center stage, and that is now more important than ever. The near-term scenario will be characterized by opportunistic stockpiling through profitable contango trades using these mega floating storage vessels. This will keep charter rates for crude tankers at an extremely elevated level, allowing them to earn supernormal profits. Is this phenomenon going to last forever? Of course not. At some point in time, the contango trade will fade away. The question then is, how fast? Several scenarios might pan out over the next 6 months. So in scenario 1, basically a short-term scenario, if the world continues to be on lockdown, or if the lockdown is extended in major parts of the developed world, demand for oil will remain weak, and this will likely continue to favor charter rates for crude tankers for oil storage. This is likely the blue sky scenario for crude tankers. If there is a second wave of virus outbreak resulting in the reinitiation of the nationwide lockdown, the stock market will likely collapse, but not crude tanker stocks this time round. In scenario 2, which is another short-term scenario, in a more coordinated effort between OPEC Plus members and the US oil producers, agreed production cuts increase from the current 10 million barrels per day to 30 million barrels per day. This will likely result in a negative price shock for crude tanker charter rates, and we could see an extremely swift reversal in day rates. In scenario 3, which is a short to medium term scenario, the world progressively opens its economy and getting back into the business. Depending on how fast oil demand picks up, we will see the oil supply demand gradually normalizing. However, this might not be a swift process. No one is expecting all businesses that have been shut down to get back up and running from day one onwards. Many might be shuttered forever. Airlines, cruise ships, car travel to a holiday, or crude input intensive activities will see a slow return to normal. This process could be gradual at best, which could be a rocky time for crude tankers. The reason being that floating oil storage is almost twice as expensive as land-based storage. So oil inventory owners will look to run down floating storage first before utilizing their land base. Once the crude tankers lost their secondary purpose as an alternative oil storage platform, they will have to revert to their primary purpose of ferrying oil to support global growth. Unfortunately, as highlighted, global growth is not coming back fast, and hence neither should oil demand. The lack of oil demand from importing nations will crimp demand and subsequently the day rates of crude tankers. This means that the current elevated rates will start to decline, potentially more significantly in second half 2020. On a longer term outlook basis, using a longer term horizon, as things gets back to normal, the inelastic nature of crude demand, which is linked to the economic activity, begins to return to normal as well. However, oil demand might not reach the 2019 level anytime soon. Might that imply that the party for crude tankers is over? One will now have to turn to the supply-demand dynamic of the crude tanker market itself. I believe that the improving supply-demand balance of crude tankers, which is projected through 2022, should continue to lead to a tighter market. The current order books for VLCCs are now at a low point after the bumper delivery in 2019. The same can be said for Suezmax vessels as well. Estimates for 2020 vessel delivery will likely be revised downwards due to construction delays in shipyards all over the world as a direct result of the coronavirus. According to the UK shipping research house Gibson, the tanker new building order book is at its lowest in 25 years at 7.6% of its global tanker fleet in November last year. Not only is the order backlog dwindling, new orders, especially for the capital-intensive VLCC class, have fallen off a cliff in the first quarter 2020 as well. The more new orders remain subdued, the greater the potential for a lasting bull market down the road finally. To summarize, the short-term bull market could potentially find support in storage and contango, where day rates could remain very strong. In the medium term from second half 2020 to the end 2021, things might get choppy for crude tankers depending on how quickly oil demand returns. In the longer term from 2022 and beyond, the new building backlog and current weak contracting for new tankers could result in a supply-driven bull market where day rates appreciates at a more sustained level. So we have talked about the dynamics of the tanker market. Which are the tanker companies that will benefit from this current high day rate trend? It is natural that the crude tanker company with the largest spot exposure will see the greatest benefit from the current day rate trend. If rates have already been locked in on a time charter or long-term basis before the strong increase in rates in this quarter, then the crude tanker company will not be able to capitalize on the current positive price trend. Coming into 2020, most of the crude tanker companies have a pretty high level of spot exposure, generally over 80%, with Nordic American tanker being 100% exposed to the spot market. The average spot rate coming into the first quarter 2020 is on average 40% higher than 4Q19 high level mark, which pretty much guarantees that first quarter 2020 results will be significantly better than 4Q19. With day rates at around 80k mark for Swissmax and 150k mark for VLCC in April, with forward bookings of 60 to 90 days, we can almost be assured that record profitability is again in the bag for 2Q 2020. First half 20 looks like it's going to be a bumper harvest for crude tankers. Based on extrapolation using 4Q19 profit figures, TK tankers looks to be trading at only 1.6 times forward price earnings. This multiple might be even lower if I'm to use first quarter 20 earnings as a basis. In terms of cheapness, it seems like TK is ranked number 1, followed by DHT and Euronav. The key issue for TK to me is that its net gearing level is pretty high at close to 1 times net debt to equity. Comparatively, Euronav has the lowest gearing profile among the tanker names under consideration at only 0.5 times. In terms of break-even efficiency, DHT likely stands head and shoulder above the rest, with an average cash break-even level of $15,000, which is pretty solid for an operator of mainly VLCC vessels. An area which I like to highlight is that DHT has taken the current high rate to fix 6 additional VLCC vessels on long-term contract at an average rate of slightly more than $60,000 for 1 year. This seems like a huge discount over the current spot rate of at least $120,000 to $150,000 per day. But it shows management discipline in terms of securing a more stable revenue stream over the next 1 year. Note that the key risk for this tanker sector, in my opinion, is the medium-term transition where the contango spreads shrinks and oil is gradually being absorbed into the system. Without a robust global economy driving the oil trade, the demand for oil tankers might shrink significantly, particularly in second half 2020. By locking some of its vessels into longer-term contracts at a fixed rate, DHT ensures revenue and earnings visibility potentially into 2021. In conclusion, the risk to reward outlook for the crude tanker industry seems to favor a cautious entry. No doubt it is going to be volatile and crude tanker share prices might whipsaw based on news flowing out of OPEC. However, with 2020 earnings likely to be a record year and their prices nowhere near record levels, in fact very much closer to a bottom where the industry has been on a structural decline for the past 2 decades, now might be just the right time to take a slightly more positive view of the industry, one which has a strong short-term catalyst and supported by a favorable long-term supply-demand dynamic in the form of a record low new building backlog. This means that not many vessels will be coming on stream ahead. We have come to the end of the video. Do hit the like button and subscribe to the channel. With that, this is Royston signing out.